And now I'd like to present the directors of Altfest, who will give you a behind-the-scenes look at what's timely now. And this is moderated by Andrew Altfest. You could guess who he is, right? Executive Vice President of Altfest, who will introduce the speakers.
Hi, everyone. I'm Andrew Altfest, and we're going to talk now about what we think is timely for everyone here to consider financially. What are some timely financial planning strategies that you should have on your minds? And you know, it's very interesting for us to think about everyone individually. That's one of the most interesting things about being financial advisors, is that really no two people are the same. But we see some common themes right now with people living longer. Stocks have done very well, as Lou mentioned. Bond yields are incredibly low right now, and it's almost insulting to look at these bond yields. They're so low. And so stocks have moved up, bonds have moved up, and we don't think that investment returns will be as strong going forward. But yet we need these investment returns to meet financial goals. So we have to think about alternatives and what to do today. At the same time, there are new products that have come out in areas like long-term care. Taxes have moved up in the last couple of years and are taking a bigger chunk out of people's wallets. And inflation has the risk of rearing its ugly head and returning. So there are challenges and there are opportunities, and luckily you have us to help you figure out the challenges and take advantage of the opportunities. I'm going to introduce our panelists. Many of them you already know, but I'm going to formally introduce them. Everyone on the panel tonight has been with the firm for at least 10 years, and these are the people who all advisors at the firm report into. And so they're really active in day-to-day client strategy, and it's been that way for the last 6 years. So we have Paul Palazzo, who's a managing director. Paul's been with the firm for 15 years, and he's the head of the firm's financial planning committee. The financial planning committee specializes in different areas of financial planning, like insurance planning, tax planning, retirement planning, Social Security, claiming strategies, lending, and I'm probably leaving some things out. Mike Prendergast has been with the firm for 14 years. He's a director, and he's on the firm's investment committee and financial planning committee. And then Ekta Patel, who's been with the firm for 16 years. She doesn't look it, but she's been with the firm for 16 years.
Very long time.
And she is a director and a member of the firm's 4-person portfolio action group. We have over 10 people now working in investments and specializing in different areas of the investment universe. So I'm going to tell you a little bit about the format for tonight. Each of the panelists are going to speak about things that they think are timely and that you should be considering for your financial plan. And after they speak, I'm going to ask each of them a question, and then we're going to turn it over to you for your questions. On that note, I'm going to turn it over to Paul.
Thank you, Andrew. So at Altfest, we have as Andrew mentioned, a financial planning committee. And the work of this committee is basically driven by one very basic concept. Don't throw your money away. Get your money's worth. As you heard Lou mention value, and I'm sure you've heard it many times over the years, value is a hallmark of the firm, and one of our jobs, sound financial planning, is one of the ways that we can provide additional value for you, our valued clients. And along those lines, one of the conversations that we're having a lot with clients these days, as Andrew alluded to, is in the area of long-term care insurance. And that makes a lot of sense when you stop to think about it, because many of you are in that age group where that discussion makes sense. The landscape in long-term care insurance is changing a bit. sales of policies, the traditional long-term care policies are down, and they're being replaced to some extent by policies that combine an element of long-term care with an element of life insurance. And one of the reasons for this, perhaps the primary reason, is because the number of people are wary of buying a product where they're going to pay premiums for a lot of years, and the risk is, in their eyes, that they'll never use it. And that's certainly an understandable sentiment. Long-term care policies can be expensive, the premiums, and people tend to think of them at a time when they're approaching retirement, and the idea of taking on any new outlays, any new expenses can be a bit anxiety-provoking and make us a little bit nervous. However, that risk exists in any insurance policy, and that in itself, in our view, is not a reason to not have the insurance or to go with a hybrid policy instead of a basic policy. Like everything in financial planning, it's an individual decision. And that's where we want to come into play and help you. We want to be having those conversations and help you sort it out and help you think it through, whether such a policy makes sense. And of course, we're your fee-only advisors, so we have no financial stake in that one way or the other. You can count on us giving you objective advice. If you need a policy and you don't have an agent, we can point you in the right direction, but that's not going to be the end of it by any means. With any insurance policy, the details are extremely important. What you're paying for, what you're getting out of it, and it's no different with long-term care. So we want to be able to talk through those elements with you as well and find out what works best in your particular circumstances. So we look forward to having those conversations, and while a little different insurance subject, we also want to be sure that you're all adequately insured in the area with personal liability coverage, that if you get sued, and knock on wood you never do, but if you get sued, that you're adequately covered. So you might think from that insurance is the only thing that we do, but of course it's not. We on the committee have a number of specialties. We have our own areas that we specialize in, and we follow the latest trends and stay up to date on everything that's going on, and we share that information with one another and with every advisor at the firm so that they can then share it with you and help you solve your financial issues, whether it be regarding taxes or retirement or college planning or charitable giving. We want to be there for you. At some point, interest rates will go up. However, in the meantime, some of you may have the opportunity, if you haven't done so already, to refinance an existing mortgage. If so, if you think you're a candidate for that, if you think it perhaps makes sense, give us a call. We'll help you analyze that and whether it makes sense. And if it does, we'll provide the tips so, again, that you can get the most for your money. Similarly, with the markets having gotten expensive, Lou and Andrew and I and other members of the Financial Planning Committee will be discussing our own assumptions for investment returns going forward and how that impacts the retirement plans that we do for you. Now, there's no reason to be nervous about this. It's not as though any changes are going to have dramatic impacts on the results of those plans. However, we do want you to know, to be aware of these things, because we want you to understand that as your representative, we're always looking for ways to sharpen the tools that can help you reach your financial goals.
I think a lot of people in the room are thinking about long-term care and saying, is long-term care insurance appropriate for me? Who would you say that long-term care insurance is particularly appropriate for, and who would you say it's not appropriate for, in general terms?
I would say if you can afford the premiums and you're concerned that you might not be able to afford an extended stay in a nursing home or an extended need for long-term care, then it's appropriate to discuss it. And I would say there's no perfect age group, but I would say if you're 55 or over, it's appropriate to discuss it in the context of your overall retirement plan. The answer may be different, will be different for different people. And I think it's not a black and white decision similar to should I buy a place to live or rent a place to live. I think for many people, the answer will be that a long-term care policy makes sense, but there are so many variables that go into the policy. You can buy a policy with a $100 daily benefit or a $300 benefit. You can buy one that has an inflation rider and one that doesn't have an inflation rider, one that has virtually no deductible and one that has a very large deductible, relatively speaking. And there again, that's going to affect the size of your premiums and what you can potentially get out of it. And it'll be different for different people depending on your retirement goals, your estate goals, your health, and various goals that you have in your own personal circumstances.
Well, hello everyone, and I've been asked, speak for a few minutes about timely tax topics. Which tax topics are timely, you might ask? Which are hitting the top of the charts in the tax world? It's always the ones that can save you money. But how do we know which tax-related topics are the ones that can potentially save you money? And the way that we do that is by analyzing each and every one of yours investment, charitable, and financial planning situations via our towards the end of the year tax communication project. And so that's why we doggedly persist, some might say pester, for that federal tax return every single year. Because the reason is, in fact, actually, now is a good time to send one in, or to have your accountant send it in, by the way. Because we review various line items on the tax return in combination with our knowledge of your personal situation to determine if these investment, charitable, or financial planning situations, or especially as they relate to tax-related strategies, could add more to your bottom line. So I've been asked to talk about two of these tax-related strategies very briefly. One of them is Roth IRA conversions, and the other one is donor-advised funds. As many of you may know, a Roth IRA conversion is where you convert some or all of your assets that are existing in your traditional IRA account into Roth IRA assets. And the benefit of this is that once the assets are in the Roth IRA, you're able to have years of tax-free investment growth, perhaps even decades, for the rest of your life, basically. And you don't have to take any required minimum distributions ever. And if you leave it to an heir, then they too could have years or perhaps even decades of tax-free investment growth. The price, though, that you have to pay for getting all these nice Roth IRA conversion benefits is that you have to pay taxes on the amount that you convert into the Roth, and the amount that you convert is treated as ordinary income. There are many factors that need to be looked at when determining whether a Roth IRA conversion makes sense. Many years ago in Money Magazine, I shouldn't single out Money Magazine, all of the consumer personal financial press were saying, Roth IRA conversions, it's the best thing since sliced bread. If you don't have one, what kind of person are you? But the reality is, as Paul was saying with his discussion, is it's very nuanced. They are appropriate for some people, depending on their clients, depending on their circumstances. One of the key factors that's important is what is your marginal tax rate now versus what do we think your marginal tax rate might be in the future. So if you expect that your future tax rate will be higher or even the same than it is now, and you're able to pay the taxes due on that conversion from money that you already have in taxable accounts like brokerage accounts or checking accounts or savings accounts, a Roth IRA conversion could be very worthwhile. A very common situation where it is worthwhile is, let's say, a married couple, and both of them have retired, so they're not having any more of that earned salary income, but they're not at the year when they have to start taking required minimum distributions. So assuming that the couple's tax bracket will rise once they start having to take required minimum distributions because they worked diligently and socked a lot of money away in those traditional IRAs, by doing a partial or full Roth conversion, they can reduce the amount of RMDs and taxes that they'll have to pay in future years, and they'll able to, of course, benefit from years and years of tax-free investment growth. Now, this sounds like a very happy situation, and this is just one of the situations that we're looking at every single year in the Tax Communication Project to try to uncover real value to our clients like you and let you be aware of them once we discover them. And of course, we recommend that you or the three of us together discuss it with your accountant because they're the tax expert and we just have a very strong overview of all the areas, including tax-related matters, to act as kind of your financial quarterback through the process. Another item that can potentially benefit you financially, while also making your life much easier if you're materially charitably inclined, is a donor-advised fund. And a donor-advised fund is a vehicle that allows one to separate the action of contributing to charity and getting the tax donation now versus the action of choosing which specific charities you'd like to give to money, which ones you'd like specifically to give to help them out, and making those choices at a time that's more convenient for you. So for example, if you give around the same amount to charity every year, let's say you give $1,000 every year to charity, and if you decide to give a couple of years' worth of charitable donations all in 1 year up front, you could significantly reduce the amount of taxes you need to pay in that first upfront year. And assuming that you invest the savings, the effects of more years of investment and growth in your portfolio, it could be very beneficial to you. And also, it's also very good to be watching for situations like the ones we watch for in that year-end tax communication project, such as if you think you're going to have low tax rates in the future, or you might be moving to a low or no tax state. This could make a lot of sense. So for example, a couple who will be moving, what you could do is you could basically front load a couple of years worth of charitable contributions in the year where you're in a high income tax rate, maybe you're still working, or you're still in that high tax state. And by doing so, you get the maximum beneficial tax deduction for you now, and then later, you'll be able to benefit from the lower tax rate due to retirement or the lower tax rate due to your new state of residence. But contributing to also a donor-advised fund also gives you some a peace of mind, or I should actually say an avoidance of some not so fun things to do. I mean, some people might really enjoy the hassle and the writer's cramp of writing all those small checks at the end of every year. Some people might really like the stress of the year-end deadline to figure out which is the appropriate charity to give to before the clock runs out. And of course, the piece de resistance, it's always a great fun for me personally to sort and file all those charitable acknowledgement letters in case the IRS comes knocking. But if you find other things that you might enjoy more, a taxable donor fund, taxable advised donor fund might be a good thing for you. Lastly on this, I'd say it's important to remember though, that the money that you give to the donor-advised fund, once you give it, you do get the benefit of the full tax deduction up front, but you also fully relinquish all control of those assets. So there's no do-overs in this situation. So you want to make sure that you feel comfortable with the amount that you give if you front-load things, to make sure that everyone is happy at the end, your charity, yourself, and especially your accountant. With that, I'll pass it back to Andrew.
Okay, thank you. So going back to Roth conversions and Roth IRAs in general, I think something that confuses a lot of people is when they can actually take money out of a Roth, and principal versus earnings. Can you just explain that to people and go into a little bit of detail about that now?
Sure. That can be a very complicated issue, so I'll kind of give you an overview, and then of course if you have a specific situation, we can definitely address it on the wealth management team that takes care of you. When I said tax-free withdrawals, one, of course, you don't need to take withdrawals anytime, which is really, really great. You're not forced to like you are when you turn the age of 70 through your traditional IRAs. But you can take tax-free withdrawals, but you have to wait for 5 years. If you do a Roth conversion, and let's say you did it today, then the clock starts ticking on January 1st of this year. And so if this year is 2015, you've got 15, 16, 17, 18, 19, you'd be able to, at the beginning of 20, you'd be able to start taking out those withdrawals on a tax-free basis. This is different than if you just have a normal Roth IRA where you just put in contributions. You're able to, you're under the income limit so that you're allowed to make a Roth IRA contribution. And with that, in that case, you can put the money in, and assuming again that you're above 59.5, all of this is above 59.5, because if you're below that, you'll have a 10% tax penalty that the IRS imposes, which is not a fun thing. But if you do a normal Roth IRA, that you contributed to. After 59 and a half, you're able to take out, the earnings come out first, and of course, you don't have to pay taxes on any earnings. You would just have to, if you didn't wait for at least 5 years, you'd have to pay taxes on the growth that the Roth IRA generated for you. Also, of course, if you were disabled or due to death, one could take out earnings from the Roth IRA. And of course, also there's a first-time home purchase exclusion, which you're able to take $10,000 out during your lifetime for a first-time home purchase.
Thank you. So Lou mentioned in his talk that we're putting a lot of money abroad, Europe being one of the places that we're investing in. What are your thoughts, or what are our thoughts on Europe?
Sure. I think Lou mentioned that in last few years we have reviewed our equity exposure, stock exposure domestically and internationally, and revised it because we are finding more value outside of United States. Being fundamentally value investors, we're always looking for areas of the market that are really out of favor. As you may know, Andrew, that world markets largely since the crisis of 2008 and 2009 have gone up. And both Europe and US and emerging markets have gone up in a similar fashion. Here in the United States, actually, we have reached new highs. We've surpassed the highs of 2007. Whereas in Europe, things are a little different. The markets have gone up significantly, but they have not yet made new highs or even surpassed the pre-crisis levels that they had attained. So overall, we find Europe as cheap. We did move into Europe a couple of years ago. Some of you who were here with us last year may remember one of our speakers was Katrina Dudley. She's a co-manager of a mutual European fund that we invested in. And she spoke at length about the attractiveness of Europe as well. In her opinion, few things have changed since our last conversation here when you were here at annual event and now. And that makes us think that Europe is even more attractive and there's more room for growth in Europe, especially the stock markets. One of them is that more recently the worries about recession in Europe is disappearing. Primarily because what the European Central Bank has done more recently, they have actually stepped in and essentially sent a message that they will do whatever it takes to revive the growth. They are doing what Lou mentioned, Federal Reserve did in the United States a few years ago, where they engineered the asset prices to go up and the stock markets to go up. So that's what in investment world, what people call quantitative easing. So that's the program that European Central Bank is initiating. If it works out, that should be very positive for the economy, and in turn, it should help reduce the unemployment, which in many countries in Europe are significantly high. The second thing that has happened in last year or so in Europe is that the euro has gone down significantly against the euro, against the US dollar and other currencies in the world. That is positive for Europe. It helps the exports, especially the economies that have a big export and manufacturing industries. So, and that will boost the demand for European products around the world. People will be, able to buy more of European products. And finally, the oil prices. I think it's key in the sense that oil prices have come down significantly. Eurozone is a net importer of oil. And when oil comes down, it's a big cost that goes into corporations or even just general for the local consumers. And we feel that oil prices coming down should be a net positive in general for the economy. One risk that we are concerned about is the conversation that people have about what happens when Greece would exit. Now, frankly, I don't know how volatile the situation would be if Greece would exit. But the things are a little different if Greece were to leave Euro. If this is a conversation we were having, let's say 2-3 years ago when we were in the middle of European crisis, there were more risk to it. primarily because there were other countries like Ireland, Portugal, Spain, Italy to that extent, who were all in the same boat. And people felt that if Greece leaves, then these countries are at risk and perhaps the Eurozone will dissolve. But at this point, these other countries have gone through their austerity plans to a certain extent and strengthened their economic situation. So the contagion effect that we were talking about, in my opinion, is less of a reality. It's less pronounced. And the other thing about the risk that Greece may exit is lower is because most of the Greek debt that is owned now is owned by the institutions like IMF or the central bank of other countries. It's not big on the balance sheets of other banks or private investors. So while it's still a risk and it could be a volatile event if Greece were to leave, we feel that it's not as pronounced as it was a few years ago. But in general, when we compare Europe to US or other developed markets, for the reasons I mentioned, we feel very strongly about it, and that's why we positioned our portfolios more in Europe.
Thank you. Outside of Europe, what other regions are attractive today?
Outside of Europe, we are more recently looking at emerging markets, particularly, Asia. We have had higher exposure to emerging markets some years back, but because the valuations got rich, we kind of got out of emerging markets. We feel that the emerging market returns have been quite disappointing over the last 3 years. If you look at S&P 500, it's done very well in 2013, 14. But emerging markets around the same period of time hasn't done at all well. So when we see such disparity, it attracts our attentions to pay close attention to why that hasn't happened and what are the reasons for something to not do well. We think that there are certain reasons why emerging market would do well is because there are some structural reforms that the governments of selective emerging market countries have undertaken. So let's take an example of a country like India. From experience, I would know that when it comes to reforms, this is a country which is 1 step forward and 2 steps backward. So every time you want to get anything done, it's a very bureaucratic and challenging process. But there are high hopes from the new government of Prime Minister Modi that he will be able to efficiently enforce the reforms such as reforming the tax system. They are instituting a tax called goods and services tax, so they should be able to collect more revenue that in turn government can use in spending projects for infrastructure, which a country like India is in dire need of. Another thing that is helping a country like India is that the commodity prices have gone down significantly in the last few years. So when you have countries which import or rely on commodities from the outside world to build their infrastructure, their roads, their railways, their airports, then it's very helpful for the economic growth when the input cost goes down significantly. And finally, with India, we feel that in India or any other country like India, inflation has been a huge problem. It's always run high inflation, and that is a roadblock in terms of economic growth. And we feel that due to reforms that some of the new governments have put in place, inflation has somewhat been in check, and that should be helpful. And these are the things that not only just India, but other emerging markets are doing. They are strengthening their financial situation in terms of reducing debt overall and being very conscious about their current account surpluses. So we feel confident in the state of these emerging markets, but again, it's a very selective process. Not all emerging markets are alike, so you have to be careful to where you're taking exposure to. So while we like them in general, we are careful as to where we want to put our money in.
Thank you.
I have a question about transferring to a Roth. I started giving money to my IRA years ago, too many years ago to remember. But at that point, it was after tax money that I gave, and I don't know, 12, 20,000, whatever. How can I give that money to a Roth?
That's a very good question, and that's a very common question. Whether you like the answer or not really depends on your specific situation, because it really depends on how much money you have in all of your traditional IRAs and what percentage of those traditional IRAs are after-tax contributions. Because what the IRS says is that, no, you can't pick and choose what you'd like. You can't take, if you have a $100,000 traditional IRA and you put $20,000 in after tax, you can't say, I'd like to put in that $20,000 that I had put in April 3rd, 1986, but nothing else. You can't really do that. What you have to do is the IRS says you have to, when you make a $20,000 contribution, you're going to have to put, what goes into the Roth is a pro rata portion of your total traditional IRA, meaning that 20% of the $20,000 that you put into the Roth conversion will be after-tax money that you put in a long time ago, but 80% of the money that you transfer into the Roth will be taxable money. So you can get it in there, but depending on how much other assets you have in the traditional IRA that have been put in on a pre-tax basis, you'll have to do a pro rata version.
When Lou said that inflation is coming and we should be prepared, how should we be prepared?
I'm going to take that question. So there are a number of things that you can do to manage inflation risk. First, depending on your portfolio, there's certain investments that will manage inflation risk better than other investments. So let's say stocks. Now what happens with stocks are publicly traded companies, and companies over time can increase prices with inflation. I mean, that's what inflation is, increases in prices. And so companies will raise prices and can do well in inflationary periods. Bonds, on the other hand, struggle when inflation moves up. And this is going to be a question that will, I think, play nicely into Michael's talk, because in the areas that he invests in real estate tends to be a good inflation hedge as well. So that's one thing that you can do. And I think it's also, in terms of looking at your own retirement plan and your financial plan, working with us so that we're thinking about how your own expenses will track in higher inflationary periods, and we're using more conservative assumptions in your own retirement plan. And so just thinking about a scenario of higher inflation is also smart, and then making any adjustments as a result of that scenario.
I would also say that stocks in general over long term are good inflation hedge. So if you have them in your portfolio, that should certainly help you against increase in inflation.
And I know that also there have been certain bond mutual funds that we put in the portfolio that sometimes benefit from adjustable rate mortgages or benefit from floating rate loans, so that as inflation goes up, they're able to reset the payment that they send on to the bond owners.
We've made some serious adjustments in client portfolios because we're thinking about inflation risk. And so the bonds that we invest in now, investing in bonds that are shorter in maturity, that are going to mature not in 30 years, but mature in let's say a few years. And those bonds tend to be less affected when inflation moves up, because you'll be able to get your money back and reinvest in, when inflation moves up, interest rates move up, invest in higher yielding securities at that time. So we've been very thoughtful about inflation and tried to manage some of the inflation risk in terms of what we're investing in, and bonds, because they are more susceptible to inflation risk, being one example of that.
Great. Thank you all very much.